Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Friday, the 14th of August, 2026. In this episode, we'll review all of last week's key data and geopolitical events, as well as a quick preview of the week coming and anything of interest that we see that we think you should know about. So it's a 30-minute episode, and I'm joined by two distinguished guests. We've got regular contributor Sam Cutler, portfolio manager at 333 Capital, and we're also joined, we're very fortunate to be joined by one of the most widely respected and quoted currency experts, Marc Chandler. He's been analysing and advising on the global capital markets for more than 30 years. As a keen observer of the interconnection of international politics and economics, Marc appears frequently in financial press such as CNBC, Fox Business, Bloomberg TV, and on the radio. Barron's, also the Financial Times, the Washington Post, and more, where he provides his colour and take on the global financial and economic news. So welcome to both my guests. Thank you for joining me today. Before we get into the week ahead, or week gone and the week ahead, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, let's get straight into it. We'll look at the week that was, basically. And I guess the feature report was the US inflation, both CPI and PPI data. And generally it was in line with forecasts, which generally the perception was it took the heat out of hype chatter for the time being. Marc, if we take you first, what were your initial impressions of what we saw from both the CPI and PPI data this week?
Yeah, sure. Thank you. I think that we've been seeing a trend of data from the U.S. that has been disappointing to expectations. I agree with you that the CPI, PPI were largely in line with expectations, but slightly softer than it was previously. And the same thing is true about the retail sales data today. Unexpectedly, U.S. shoppers stalled. Retail sales actually fell 0.6% in the month of July. The market was looking for a 1/10 gain. The net result of all this has been, as you mentioned, for the markets to downgrade the likelihood of a September Fed rate hike.
I was surprised because we've seen the US household has been really resilient over the past, I'd say you could call it a year if you like, even longer. That it chose now. Do you think this shows signs that the crisis in the Middle East is just starting to chip away at that resiliency of the US households?
I don't know. I'm not sure that's really the case quite yet. I want to see some more data. You know, one measure the economists talk about often, GDP, right? That's all the goods and services an economy produces. But when you strip out some of the sort of the volatile elements, the noise elements, and we want to get a reading on the domestic economy itself, the economists call it the measure final purchases to domestic parties. So this excludes inventories, it excludes government spending, and it excludes trade. And this number was actually showed consumer strength through Q2. And so I did know that, you know, I in my overview of seeing weaker economic data, of course, it began on August 7th, really, when we saw an unexpected loss of jobs. And wage growth in the U.S. is slowing, so that when we adjust for inflation, real wages are no longer keeping pace with inflation, and this sort of acts as a dampener on consumption. Americans have been able to manage the consumption partly by going into savings. And this obviously has some limit to it as well. So I think that
Sure.
here we are in the middle of Q3, and I think the state of the consumer is precarious, supported by job growth overall, even though it's begun weakening, and going into savings. And of course, Americans use a lot of credit, primarily revolving credit.
Mm. No, interesting stuff. Sam, from a market trader's perspective, how did you handle this or deal with this week's figures? Again, they were pretty much in line. The inflation rate was in line. I think 0.4%, reversing the dip seen last month, and the year-over-year was also, I think, a tenth slower than last month at 3.4%. Market reaction, and we've seen what we've seen in the 10-year in the yield bond yields, which is probably a bigger story, existential story. But how did you see the market moves?
Yeah, so I mean, we got kind of everything pretty much in line with consensus, and I think the market was kind of pricing that in the prior days run up. If you look kind of the moves in stirs or some of the kind of longer dated yields there, and with the CPI and PPI in hand, we pretty much have a base assumption now of what core PCE is going to be tracking, and I have them modeled right now around like 19 basis points on the month, so it's going to be a cooler print there as well. But you did see post the data there, September hike odds continue to kind of slip out. I think right around this morning, pre-retail sales, we had about 6 bips priced into September, which would put us right around like 28-30% chance of a hike.
Yeah.
Now, just to touch on that retail sales component, because it is a really volatile data set, right? And nevertheless, we did get a big miss in the control group sales, but there are some seasonality factors in there. There's a little bit of give back from the Amazon Prime Day sales. And I had spoken to a retail analyst earlier this morning, and she had mentioned that a lot of the names she deals with on conference calls, that they had mentioned a pause during the World Cup, and they do see August bouncing back up. So it's just something to keep in the back of your mind that we could see a little give back here on the retail sales in the following month. But if we get back into the inflation metric, right? Like, my personal opinion here is I do think the right tail on inflation is not something that is really going to need to be worried about. And I know that's a pretty bold statement to make, but if you look at the data, we're seeing trends in the right way. The tariff impacts are coming out of the market. Shelter is somewhat continuing to cool, but the main thing the market seems to be worried about right now is obviously that this Iran war, right? And there is a catch in all this data because it's backward looking, right? It tells us the energy shock really didn't hit any of the July data. Not that the energy shock is gone, right? If you look at Brent, right, it's back at 87, $88 today. I think it's up about 5% for the week. So what we're kind of seeing is screen pressure fading, right? That kind of the physical issue still remains in place, right? Which is crude exports, insurance, shipping capacity, refining, and obviously the reliability of passage through Hormuz, right? And we're still seeing attacks on commercial vessels. So we don't really have a ceasefire. And even if we do have a ceasefire that's prolonged, it's still not the same thing as normalized trade. So my big worry here is that oil doesn't really need to produce a large spike for the macro consequences to matter, right? A prolonged period at these levels in the higher 80s for Brent is still going to likely affect headline inflation, household purchasing power, freight costs, and corporate margins, right? And I think you see that in the market reaction here. If you're looking at, let's say the 230s or the 530s curves in the US, right? We can see the front moving lower as hikes are postponed, but the long end is still carrying that fiscal issuance and term premium risk. So we continue to see kind of a steepening in the curve. So it's not necessarily a dovish, bull steepening of the curve.
No.
That's how I'll leave it.
No, yeah, fair enough. And we did see Beth Hammack, Fed governor, Fed member, committee member, Beth Hammack just basically doubled down on her hawkishness, I guess, really, yesterday when she spoke. And Mark, do you think those voices will start to grow on the FOMC, the hawks on the committee, and will there be enough pressure by the time we get to September? Bearing in mind we do have another round of data to get.
Yeah, I think you're right that at the July meeting there were 3 dissents, and Hammock was one of those dissents that wanted an immediate rate hike. But I think that with the loss of jobs and the slightly softer readings on CPI and PPI, and even today's perhaps distorted decline in retail sales, I don't think that those 3 dissenting hawks are going to be able to convince many others to raise rates in September. And I try to put myself in the new chair's, Kevin Walsh's mind. Remember, one of his ideas is that he's not a big fan of the summary of economic projections, the dot plot. In fact, at his first meeting in June, he didn't even participate in the exercise. If I were him and I wanted to try to decouple or de-emphasize those dot plot, that summary of economic projections, I would not change policy when they come out. And in September, they're going to be updated. And so if they were to change rates in September, it would reinforce that linkage between the summary of economic projections, arguably a type of forward guidance, and Fed policy. So I think try to game it out, but also looking at the economic data, I don't think people would have changed their minds. Those who wanted to raise rates last month, no big reason to change their minds. But the same thing goes for those who just wanted to stand pat and wait for more economic data. Nothing has really, I think, sort of been that last drop of tea that overflows the cup. I don't think people's minds have really changed. What I do note is that in the past 3 weeks, the U.S. 2-year yield has fallen by 20 basis points. In fact, when I look out at what's happened, it's only risen 1 day a week for the last 3 weeks. And this past week, it was on Monday before that soft inflation data and the retail sales.
Good stuff. I hadn't noticed that myself personally, but yeah, interesting stuff. I want to jump across the Atlantic, and we'll come back to the US situation. And obviously, we refer to the softer non-farm payroll, which many have put into a box and said, look, until we start seeing a trend of negative prints, we're going to call this an anomaly. Not an anomaly as such, but the ebbs and flows of what we're likely to see, and they probably want to see more evidence that job market's being meaningfully impacted. Really, we also this week had an RBA rate decision. Bank of Japan published a summary of opinions. Now, Japan and the yen has been a talking point for many of our sort of clients over the past 3 to 4 weeks, and some of the moves that we've seen there, and also the fact that we've learned that the US Treasury has been getting involved in the currency market game as well. We can look at that in a bit as well, because I do think if we're looking at what's been, I think, on the volume level, quiet summer for the markets, some of the derivative markets, there's still been a lot of action, a lot of movement, and there's likely to continue to be with everything we've seen in the Gulf, and obviously with this Japan situation as well. So it's one we have to watch. And really, I want to finish on the week gone. Trump changed tack on Iran. He's now says he wants to play the long game and hit them economically. Does this just prolong? It's a rhetorical question. Does it prolong the uncertainty, Mark? And do you think markets will eventually just become inured to the comings and goings of the Middle East crisis until we get some form of conclusion to it?
Yeah, I do think that the war on Iran, the war in the Middle East, is really the second U.S. shock. The first shock, of course, is the U.S. tariffs. And I think that the market's come to a point where we're at it looks like a stalemate. Iran thinks it has the upper hand and has gone on the offensive. The U.S. continues to claim it's got the upper hand. And this, the U.S. now, this change of tactics you mentioned, we've tried this before. The U.S. has had all kinds of sanctions and trade restrictions on Iran. What worries me, I think, is that there's countries like Russia and China that have a vested interest in delivering to the U.S. in Iran what the U.S. and NATO delivered to Russia in Ukraine. That is, as a trap. That's what we think we did, right? We didn't encourage Russia to attack Ukraine, but once they did, we sort of, the trap like unfolded. And that trap was arming Ukraine with weapons and intelligence so they could fight the Russians. Similarly, I think that Russia and China have a vested interest in keeping the U.S. occupied in Iran, where the U.S. has diminished not only its weapons, but it's also cannibalized defensive weapons that were strategically in place to help defend South Korea, Taiwan, and our other allies in the Pacific. So I am concerned that the longer the war goes on, of course, the more disruptive it is. And the International Energy Agency said it's the most disruptive of the energy market ever. But I'm concerned that it's not just energy, because remember that a lot of our food production requires pesticide and fertilizer, and those basic ingredients for those also come from the through the Straits of Hormuz, the Middle East. And this is on top of, we're talking about shock, sort of the weather shock, the heat in Europe and the U.S., coupled with the lack of fertilizer, pesticides, probably means lower yields. And we're already seeing the UN's index of food prices rise to a couple-year high.
So again, as Sam was saying earlier, as this chips away, we start to see more and more of it erode that maybe potentially the US economy and more the global economy. But surely, in terms of the waiting game for the Chinese and the Russians or whatever, it's only meaningful in terms of running down the US stockpile of weapons if the two countries decide to step up and say in China's case, look at Taiwan and start making moves on Taiwan, or if Russia decides to step up its war against Ukraine. So again, it's an existential threat in some respects, isn't it?
Yeah, I think so. I think that it's remarkable so far how reserved, there's a lot of frozen conflicts. And I'm surprised about the level of reservation or reserve that both Chinese and other countries are showing, not sort of causing that kind of existential trouble that they could given the U.S. preoccupation and low weapon, low munitions. So it's remarkable, but it seems very precarious to me.
Yeah, actually. Sam, you keep one eye on a load of different markets. Based on what we've just been talking about, how do you manage your portfolio based on all these existential risks that are out there at the moment? Do you keep it? Are you fairly conservative still at the moment? We're 8 months into the year now. With the shock we got at the start of the second quarter, the midterms coming up in November, this ongoing Gulf situation, as I said. Would you keep it tight at the moment?
Yeah, I mean, we're still running pretty tight risks. I mean, we're still naturally long the market, but that's, accompanied with some, strong beta hedges against the indexes themselves. And, there's a lot of stuff in the rate space right now, but I still don't feel like it's a really good time to have direct notional duration exposure, right? It's a lot of, relative value trading, trading markets versus markets. Currently we're trading, 530 steepeners in the US, but we have that paired with, Australian 310s flatteners, so a lot of relative value stuff. I think there's some opportunity to capture as, this essentially the oil transmission hits different economies differently, right? And you want to touch on the Trump stuff, right? Like you and Mark both mentioned, right? The military offense pullback and going into economic pressure is probably partly due to the weapons stockpile in the US having been dwindled. And you have to assume that Trump's a little worried of an unpopular war with the midterms approaching, right? But the issue I have on the economic front is he has completely underestimated Iran so far. That's how it seems. And the sanctions take a long time to bite. The closure of Hormuz bites right now, right? So from a headline perspective, economic pressure sounds a lot better than escalation, but the oil transmission is still the same regardless. So I still think that's the big big caveat to the market. And we still see that on a day-to-day basis, right? Especially if you're looking at kind of the stir market, right? The correlation with, Brent and WTI is just, it's so strong, same thing if you look at, European rates. If you take, your Euribors and you pair that with, natural gas prices, I mean, they're going tick for tick with each other. So like I said, I think it's very difficult to have, directional views at the moment, but I think there's a sufficient amount of opportunity on the relative value front.
Okay, fair play. Let's start looking at the week ahead, because it's a busy week in terms of output there from around the G7 and beyond. We headline with the FOMC minutes, and we've sort of touched on the Fed and Beth Hammack, one of the voters, and her insistence that she still looks for a hike. We have played out the current situation for the Fed with the data that we've had so far. I'll come to you first, Sam, on this one, because from a trading perspective, will you pay much attention to the FOMC minutes? What will you look for within the publication to make you push a button, for example?
Yeah, I mean, as we've spoken about before, I mean, I don't find much value in the minutes at all. And with, the committee voting 9-3, I mean, the only thing I'm going to pay attention to, I guess, is the texture of Hawkish Dissents. And, the one thing I also want to pay attention to is how Walsh kind of framed higher long end yields as doing some of the tightening for them, which I think is, based a lot of the color behind the September debate. But the thing is, we still have another jobs inflation report ahead of that meeting. And I think that's going to be more market moving for the September meeting itself than any of this data was. So, I mean, the minutes, it's interesting to see. You can get a little bit of texture from it, but it's not something that goes up high on my list of priorities of something to view.
No, fair play. Mark, you were the same opinion on that front?
Yeah, no, I'd agree. I think that Walsh is trying to restrain the Fed's communication, being less transparent, lack of forward guidance. And I think that what we've seen with the statements following the FOMC meetings is a much terser, shorter statement. And I think we're seeing that as well so far with the first set of minutes from June. And I expect that to be repeated in July, where they're not very revealing. And they never really were so much. But I think that for me, the issue is how close would, back in June, 9 of the 18 FOMC members that cast a vote, remember Walsh didn't, 9 of them thought that a rate hike would be appropriate this year. 3 of them dissented in July. Where are the other 6? And I think that's what I'm going to be looking at is,
right.
Like we talked about, Hammack's view is well known. She's a hawk. She dissented. Now, what about the other 6? And that's really where I think the focus is, to see, can the hawks put together a majority? And right now, it doesn't look like it.
No.
And I think one thing to note on that too is I just wanted to mention as like a counteract to Hammett, right? Because we had Goolsbee kind of make some comments that did kind of reinforce the direction of travel in the front end of rates lately, right? He had mentioned that inflation obviously remains too high, but the recent readings have been better. So I think, if you're looking to where those other members sit, let's say they were kind of sitting neutrally, I think the last few data prints has given them a reason to be a little more patient. And I think the reaction in the front end of the curve is kind of telling on that front as well.
Yeah, good night. Good pointers. Looking down the data points for the rest of the week, again, we've got mainland China activity data due up. I've got a piece here from HSBC, says, in terms of mainland China, industrial production should stay resilient, led by strong exports, while the property sector continues to be a drag and retail spending remains soft. Mark, as we were talking pre-recording, China makes, was it 85% of all aircon devices out there at the moment. So again, in a world that's heating up, as we've seen over the past month or so, 2 months, and year after year, they're probably in the right game.
Yeah, I think, on Monday, the week begins off with a lot of Chinese data. They report basically the macroeconomic data. Most of it comes one day a month, and that's going to be on Monday. And it already looks like the economy really has softened and doesn't really look like it's picking up. Here we are at the start for them of Q3. So that means that retail sales might have retail sales basically flat year to date on a year-over-year basis. Industrial production might be a little bit softer. But one thing that really catches my eye is the decline in investment, CapEx. And this is partly China's effort to try to get more control over the excess capacity, what they call involution. And I think this is an important factor. And at the same time, today, Friday at the weekends, the Beijing, the PBOC, the People's Bank of China, set the dollar's fixing at its lowest level since February 2023. So still signaling a tolerance of gradual RMB appreciation. It's not fast enough for the Chinese critics in the US and Europe, but it is the strongest currency in Asia, and it's outperforming most of the G10 currencies so far this year.
Some good knowledge there. Thank you for that, Mark. We'll also get global PMIs out this week as well. Flash PMIs for August. We should give us a bit of for August. Is that right? That's right. I'm pretty sure it's August. Let me just double check my records. But yes,
yep.
And hopefully they should give us a bit of a reading as well into the state of the global economy based on the fact that we're now in, I think, 15 weeks of probably longer of this war to date. We'll also get first look at second quarter GDP, and we'll get CPI prints out of Japan as well. Again, going back to that summary of opinions, it does seem that the Bank of Japan, and I'd take these under advisement, are looking at that a little bit closer, edging closer. I think October is still probably the prime time for the next hike to take them above the 1% market at present. Sam, you've been paying any close attention to what we've seen with the yen and Japan of late?
Yeah, I mean, I think there's obviously some cause of concerns for me how every time intervention seems to take place in this yen, it gets immediately faded, right? And I think it's Japan needs to take action, right? Now that the government has kind of came out and said they support a September or October hike, I think we're going to see that, right? The policy rate is what, 1%, the highest since 1995. CPI was running, I think, 1.7% in June. Their July summary flagged some upside price risks. Firm GDP and kind of another sticky CPI print, I think, hardened the case for them to hike in September. And I'll be very curious.
Sorry, go on.
I was just gonna say I'll be very curious to see if they do come to hike, what kind of moves we get in the yen. But I think Mark could probably provide some more color on that than I can.
Yeah, Mark, what's your input on what we'd like to see out of Japan?
Well, what I see happening is really since the intervention back in late July, that the odds of a September rate hike in Japan have increased. So, for example, on the 31st, at the end of July, the swaps market was pricing in about 10 basis points of a hike. And now, in September that is, and now it's 20 basis points. But in my work, I find that as much as I understand the logic, Japan has 1% interest rate. Most of the rest of the world, leaving aside Switzerland, has higher interest rates. That keeps pressure on the yen, at least theoretically. Because in my work, what I find is that the dollar-yen exchange rate is more sensitive to U.S. interest rates than Japanese interest rates by a wide margin. And so I think that, to me, the yen's weakness, which is not so, I think that the yen's weakness is a bit exaggerated, primarily because we were at 40-year lows for the Japanese yen. But it was only down about 3.5–4% before the intervention, which in currency terms is still a rather modest move. And so I think that the U.S. dollar is overvalued against almost all the currencies in the world, the major currencies, the G10 currencies. And this is by the OECD's model of purchasing power parity. Asian currencies, including the yen, have generally underperformed because of the popularity of the carry trades. So if an investor wants to pick up yield, they could sell the yen and buy, say, Mexico or buy Brazil, locking in a much higher yield. And so, but that's true for almost all the other Asian currencies as well, including Taiwan, Indonesia, South Korea. And so I think that what we really have here is not so much a case of a weak yen, but a strong dollar. And I think that change in U.S. policy from the expanding fiscal policy, we recorded earlier this week the largest July budget deficit on record, despite the economy growing their trend. So to me, the real way to stop the dollar from rising against the yen and rising and being firm, overvalued against most of the G10 currencies, but the Swiss franc, is for the U.S. to change its policy. And I don't think we're close to that.
No, well, yeah. No, I don't think we are at all. Okay, we're running near the end of the program. I want to just to give a heads up. We've got Canadian CPI due out this week as well. UK inflation data as well as labour market data as well will be keenly looked at, I think, as well by investors this side of the water. The Bank of England stayed again. There's a growing number, similar to the US, of hawks. But yet you can't see those current, I wouldn't call them doves, but those voters on the MPC, the Monetary Policy Committee, moving too far from their current opinion, which is to keep rates steady at the moment, especially as we do have an October budget to come from the new government of sorts, with a new Prime Minister and his new team taking charge. Does anyone have any input on the UK, just activity, the UK economy in general, or inflation in particular, to add anything to the narrative? Mark, would you any views?
I would just note that the Bank of England meets next on September 17th, and the swaps market has about 4 of 25 basis point chance of a hike. So it's about 20% chance. The market doesn't have a hike fully discounted by the Bank of England until December. And that seems about right to me. I'd say in the name of full disclosure, my own position right now is I am long sterling against the euro on a cross.
Okay. Interesting. Sam, I know you do take an interest in the UK and the UK markets and whatever, but do you have any particular sort of leaning one way or the other at the moment?
Yeah, I mean, like you had mentioned earlier, right? The Q2 GDP was solid, but I mean, we've kind of seen a lot of that before, right? And the annual rate was at 1.2%, which I think was above expectations, and it's kind of on par with the US. And I think it's only behind Canada in the G7, but I think some caution is needed there, because if you look at the details in June, right? The jump kind of leaned on some one-offs, right? You had that summer heat wave that you've been complaining about. You also had World Cup spending, right? And the quarter also closed before the last U.S. and Iran ceasefire collapsed and Hormuz flared back up. So you got services doing a lot of the work, right? Where production and construction lagged. So I think the real risk we run in the UK is if this war continues to prolong, right? Because that is going to end up hurting growth. I think some models, I don't remember where I read this, but I believe the forecast was UK 2027 growth could slow to as little as like 30 basis points or something. So I think if you take that and you couple that with, in inflation coming up, inflation in the UK has been some of the stickiest in the G10. And the last rate decision, you did see the Bank of England hold rates at I think it was a 6-3 hawkish vote there. So I think a hot print on this inflation will keep kind of that sticky UK hawkish tail alive. And I think you're seeing this, a little further out the curve. If you look at the red Sonias, they're pretty stable at pricing in, about one hike until the year end. But if you start moving out the curve and you're looking at, later dated reds, even, early greens, the pricing continues to climb out there. And, if you look at December 27th, I think we're priced at a little over, 2 hikes out to the end. So I just have a very hard time seeing that come to fruition, especially if this war drags on. I think it continues to slow growth there. I have a difficult time seeing the Bank of England carry through with the hikes. I think that can be hawkish on the tone, but I think actually pulling the trigger is going to be difficult. And if they do pull the trigger, I think that will lead to a more rapid deterioration in growth. So I think there's some, opportunities there, in the stir market, out in the, kind of later dated reds and early greens in the Sonia curve.
Good stuff. Just a quick note from HSBC on the CPI. They look for inflation to rise from 2.6 to 2.9% annually. And they say, while we expect motor fuels to have fallen on the month as a whole, that decline is mitigated by the re-rise in pump prices towards the end of the month. Capturing this might help explain why our 2.9% CPI forecast is 0.1 percentage point higher than the Bank of England's. But on the other hand, we expect core inflation to remain benign with favourable base effects actually helping the annual core CPI rate decline to 2.6 from 2.6 to 2.3%. So mixed views there. Obviously, we've got labour market data out as well as retail sales out next week. So a whole full range of data set to sort of disseminate from. I want to close out, and we're coming to the end. Obviously, we've got Australia labour market report out as well. But again, one of the, Mark, when we got you on, we were talking about this being, was it the 55th anniversary of the end of Bretton Woods? And again, it was showing my age. But I know you've written a piece on this. What are your views in the 55 years since we've, we disbanded with Bretton Woods? And if you can sum it up within a couple of minutes, how the world's changed, the financial world's changed to the better or detriment since the announcement.
Yeah, sure. So it was August 15th, 1971, that Nixon decoupled the dollar from gold. He said it was temporary. Of course, it turned into a permanent thing. And I think this is sort of the beginning of the modern era that we're living in. This is the beginning of floating exchange rates and liberalized capital movement. The foreign exchange market, which is the market I follow the closest, average daily turnover, according to the Bank for International Settlements, is $9.6 trillion a day. It's just a mind-boggling number. That means already in this week, there's been enough turnover in foreign exchange to cover world trade for a year. And so this era that we're in now, floating exchange rates, it helps those who have deep financial markets like the United States. The US, Europe grew the fastest. The strongest growth took place under fixed exchange rates, limited capital mobility. So I know it's popular now, and especially in this new Cold War setting, US versus China, that many people accuse China of sort of blocking other countries' development. But I think that the movement towards floating exchange rates and making them not just a practice, but making them into a virtue, turning a necessity into a virtue, makes it difficult for emerging market countries to develop the way the US and Europe did, limited capital mobility, and we call it floating exchange rates, which really mean volatile exchange rates. I think, too, that Bretton Woods we think about it as an economic agreement. The dollar was pegged to gold, $35 an ounce. Everybody else pegged their currencies to the dollar. It was talked in economic language, but ultimately it was an expression of politics and power. We no longer live in that 1944 unipolar world. The world had become more fragmented, arguably more multipolar, and I think this is really what argues against a new Bretton Woods agreement, though there are, of course, people who advocate it. I don't think that the power structure as such will allow for it. So I think we are still, for good and for bad, in a world of floating, volatile currency exchange rates, which require then businesses and investors to keep that currency risk in mind, especially when it comes to trying to manage that risk and hedging those exposures.
I guess this is free markets, yeah. What we've got nowadays, and you've seen the ebbs and flows of those pre-2008 and the global financial crisis, where we were getting this globalization, and maybe some argued that then a pact like Bretton's would be a good thing to where we are now. Like you say, we're going into these sort of, it's a more polarized world for however long that lasts now. But again, I was just born when this came about. I definitely know Sam wasn't around back then. I'm just to finish on, and Sam, if you got anything to add to this, if you got anything to add, but did it set the global world up for the better. I mean, we've had global financial crisis since, which is something the Bretton Woods was trying to avoid. We've had situations with currency wars and so forth. Is there no case at all for having some concept of Bretton Woods nowadays, Mark?
I don't know if going back to a pegged currency regime is very helpful. I think of it like this, that when you have fixed exchange rates and low volatility in interest rates, those things act as like shock absorbers. The economy doesn't have to be so volatile. That's the key thing we want. We don't want economic volatility because that means higher unemployment and other cyclical problems. So if what we could do is transfer that volatility from the real economy to prices, like interest rates and currencies prices that can bear more of the adjustment, I think that can be a good development. The problem, though, is that we're not all at the same level of development in our capital markets. And that poses some problems. So that's why I think it needs to be it's a political issue, and it requires some tolerance of other countries who closely manage their currencies. I don't mean about like Japan, which just occasionally intervenes these days in the FX market in huge size, of course, but also there's many emerging market countries really struggle with the volatility of the exchange rate. And this has required them to build up reserves, primarily in U.S. treasuries, pushing down yields in the U.S. lower than they would otherwise be, and then setting us up for then these serial financial crises. So I think that there's like with a lot of things, there's a trade-off. It matters where you sit, but I think that in general, having for an economy like the United States or most of the countries in Europe, having some flexibility in currencies and in interest rates prevents the economies from being more volatile, unemployment being higher. And, generally what's happened with these floating exchange rates and capital mobility is the business cycle in the US, Europe, and Japan has gotten longer and of a smaller amplitude. We've flattened out the business cycle through these opening of the capital markets. I think that is a good thing, even though there's, of course, some negative consequences.
Okay, good. On that note, great to get your point of view on that. And where can we find this this article you've written? Where can people, if they want to read your article in full, where can they find it?
Sure. So I keep a blog. I'm really fortunate. I don't try to monetize my presence on the internet. My employers have been happy to let me post my commentary on a blog, marktomarket.com. That's Mark with a C. Makes my mom happy. And I post comments there 6 days a week.
Perfect. So we will direct people to that site for sure. Mark, thank you very much for participating in today's episode. I've found it very enlightening, and I'd love to get you on again over an event, an FOMC or such like, to get your opinion. So thank you very much for appearing today.
Thank you. Thank you for having me. I enjoyed it. Thanks,
No,
Sam.
likewise, very much so. Sam, and as always, you come well prepared and know a lot about everything. So again, thank you from a trader's perspective, and your viewpoint. So cheers.
Yeah, thank you, Harry and Mark. Always a pleasure.
Excellent. Anyone who missed part of this, you can find us on the social media platforms. You can also go to where you get your podcast from and listen in from the beginning. Then we'll have this up on all the main sort of platforms, and we'll put out our guests' monikers so you can go and read up on what they're doing for yourselves. But thank you everyone for listening. Have a lovely, safe weekend. Hopefully it cools down for everyone, at least in the UK, because it's really, really hot. And we'll see you again next week.